Welcome to the Real Estate Morning Show. I'm Dylan. This is my wife Jennifer. We're realtors now 12 and 13 years in the business. This is our morning show where we bring to you all the real estate news in the GTA and Toronto that you need to know about. Today we're going to be discussing home equity line of credits and a small change on the way lenders are going to be looking at that. A new return service through Ikea where you can put towards credit of your next purchase. We're going to talk about housing affordability and Montreal's possible implementation of a foreign buyer tax. Let's jump into the show.
Read about this or not. It was just listed out today. I think most of the articles that I saw.
I didn't read it, but I have a great wife that let me know that it was out there. So
yeah, so
I'm caught up.
Basically, what's going on is TD has announced that they've made changes to their lending for second mortgages. So what this means is that it's just a minor change. TD are the only bank currently that have done it, but they are basically stating that the other banks will be following suit.
Usually how it happens.
Usually
right?
how it happens. One of the big ones goes and everyone else goes.
Yeah.
And so what this means is that if you are a homeowner and you have a mortgage, a first mortgage right now, and then you have a home equity line of credit because you have equity in your home, the banks are going to be treating that differently when they're looking at qualifying for you for lending going forward. So what used to happen would be they would just carry whatever your existing debt load on the line of credit was.
Whatever that debt obligation was, that's how they counted it.
Whatever you owed, that was debt that they broke down over the course of the monthly payments, right? So what they've actually changed it to now is that even if you have a zero balance, but you have a HELOC of any kind, they're going to be maxing that out and adding it as additional full debt load. So if you have a significant line of credit, this could hugely impact the lending you could get on a secondary mortgage. So say you want to buy a cottage or income property, you've got to be aware that that's out there. So kind of they've slid it under the table. They've kind of been quiet about it. But it is a big deal because a lot of people do want to get into secondary properties and investments, and it's a big factor there. So that's really it. Just letting you guys know that that's what's happening. So if you are in that position, make sure you check with your bank or your lenders and know exactly what that means for you. And ways you could maybe get around it, or if it's something you have to clear before you want to take those next steps.
Exactly.
Really.
You can see why the bank would do it, that it's a good idea. Like there's been all this stuff about, the average Canadian household's debt is higher than it's been before. And I think we're coming out of that now.
Yeah.
But if people had access to say $100,000 on a home equity line of credit, and then they went out and got financing in another place, and then we're like, well, heck, let me just take this extra $100,000. You could see how that could be a disastrous situation for a lot of families that maybe weren't as disciplined. So it's a good, the bank's doing it to protect themselves and all that. But it's a really kind of crappy for families that do manage their money well and do have that money there. Not that they're necessarily going to use it, but it's there if they want to, and they're going to make smart decisions. But the bank's like, oh yeah, we're counting as if you already spent all that money.
Yeah.
That part's kind of crappy, but I do understand why the bank's doing it.
Yeah, and the biggest challenge with it, it's not whether they do or don't spend the money. Really, what it comes down to is what the bank's going to be willing to give you.
Yeah.
So it's kind of like a stress test, again, in a way, because they are stressing out your debt load completely, whether you have it there or not, right?
They're stressing if you are bad with your money. Oh, you have access to all this money? I'm going to assume that you're going to spend all of that.
That's exactly what they're doing. They're just lowering that risk level even more. So just something to be on top of and know about for sure.
Ikea.
IKEA, yes. I'm super excited about this, actually. So there's a great article out there today. Actually, I think I saw it on the weekend. And what it is talking about IKEA, specifically in Canada, which is even cooler. They've ignited this new program that's basically a rebate program. And so what they've decided to do, because they're really heading in a movement of sustainability, and I mean, I think everybody owns IKEA furniture or has at some point. So they've created this new program that's a return program.
Okay.
And so how it works is it's completely free. You go to the IKEA website, you join the family list, which is kind of their program points, whatever, but it doesn't cost anything to join it. And you select your store that is closest to you or the one you want to deal with. And then you can go around your house, and if you have IKEA furniture, you can take pictures of it. You have to submit up to about 4 pictures so they can see what kind of condition it's in. You email it in or you send it in, and they reassess based on the condition of it what sort of store credit they're going to give you. They buy it back from you.
Interesting.
And so you can basically go around, take all the pictures of the stuff in your house, submit it, find out what you're going to get back, and then redecorate. So, I mean, I think that's cool. It's a great program. It's smart.
Yeah.
And, because IKEA is affordable
Yeah.
for a lot of demographics. It gives you the opportunity if you move or you get a bigger space or a different layout where maybe a piece doesn't work anymore,
Yeah.
that you can at least get something back towards that new cost, right?
Yeah, exactly. Because I mean, whether you're buying high-end stuff or not, there's always something from IKEA that's very functional that you can use at some place in your house. And so if you're getting a credit towards it, more likely that you might go back to IKEA for a piece like that and get it. I think it's a very smart move on IKEA's part.
It's super smart.
Yeah, because there's a nice incentive to say, hey, come back and try this out.
And it's gonna
we'll see how the system works.
It's gonna keep consumers coming back to the store because as far as I'm aware, I don't think any other big box stores or anything offer that type of a service right now. So if I can take some old stuff and bring it back and get a discount, I'm more likely to do that.
I mean, even if it's a small discount, you're getting just as good as like any scratch and save that you usually get somewhere, right? Like, you save the tax. Well, hey, save the tax. Why not, right?
Yeah.
Like, it's a mini sale.
Yeah, and I don't know the full details of like the small fine print of the program, but in my brain, I'm like, well, that's kind of cool. You could bring back all your old stuff, and then say you're doing a renovation or something, that could cover your cost of a cabinet or if you did it over time as you replace things. So I mean, I don't know if that's something, if it times out, I'm not sure. But anyway, it's something cool to look into.
Cool.
Yeah, and I thought it was smart, and I love the sustainability element of it. So
Yeah, I've looked at other trading programs where sometimes they give you like $5 for what the item is, and you're like, okay, come on, really? So,
and I mean that's the thing we don't know yet.
Yeah.
I have no
it's not
idea
up and running yet, right?
what. I believe you can go on the site now and you can do it, but you have to submit the photos. Someone assesses it and then tells you what they're willing to buy it back for. So there aren't set prices. You have to, because it's based on condition and I'm assuming the popularity of the product and stuff like that. Right?
But again, at least if you're not using it anymore and you put some money towards your next purchase, not a bad thing.
Yeah, exactly.
Cool.
Yeah.
I like it.
Yeah.
So I'm gonna get into the more boring stuff, I guess. We're gonna talk about another potential foreign investor tax, and we did promise that we were going to talk a little bit about affordability and how it's getting tougher for people.
Yeah.
And I've got a great visual graph to show you what that actually looks like, because you hear us talking about it. I've got a nice picture. It's going to sum it right up for you.
Yeah, sometimes it's hard to follow, but when you see it, it's like, oh,
I get it.
I see what you're saying now. Yeah.
So anyways, we talked a lot about, I guess in our market video where we talked about Montreal, prices have been going up, and they're kind of going through. They've got the lag of what was happening in Toronto and Vancouver.
Yeah, they're doing really well right now.
Yeah.
Yeah.
And so their new mayor was hinting at potentially looking at doing a foreign investor tax as well. And my article that I was looking into wasn't so much coming from her point of view, but it was coming from the CEOs of Juwai's website, the big Chinese conglomerate for all the real estate stuff that they do.
Right.
Their CEO had a lot of comments about it. I barely found any comments from the mayor, but the CEO of Juwai was all over it.
Well, that kind of makes sense because it's going to have a bigger impact on their buyers and that it really will on anybody who's in Canada, right? Who's a resident. So
well, especially in specific spots, because I think what we've learned too is that foreign investors of all countries are really looking at Canada and saying, hey, this is a good place for me to put my money. And if they're looking at Toronto and Vancouver now and being like, it got a little overinflated there, this isn't the spot that I want to put my money right now. There's a lot of other places in Canada that you can still do that, and Montreal has been a great option. And so essentially, her name's Carrie Law, and essentially she's against it, and she's coming up with her reasons for why. And there was a few things that I disagreed with. I'll have a couple of her quotes come up, but one of them she's talking about, this isn't the move that helps the most residents. She's citing that 1/3 of the city's population are owners, and then 2/3 are renters. She's like, you're just focusing on the owners, so the 2/3 really aren't being helped, but that's kind of the opposite flip, because the reason that they're doing this is so that those renters can become owners, right?
Right, yeah.
And she's saying it's not foreign investors that are driving prices up, it's the low affordability.
Right.
But as we're going to take a look at, the affordability is what's getting out of control.
Yeah.
The prices, it is definitely not all foreign investors that are causing that price growth. Definitely not. We've got low inventory, and we do have still historically low interest rates, but our qualifying process has been slowing us down a little. So there are a lot of other factors, but I do have a quote here that will kind of jump into it. She says, "We believe fears about affordability in Montreal are exaggerated. Affordability is actually what's driving prices up. in the form of high employment and low interest rates. Foreign buyers are in no way driving market-wide price of sales trends. That's preposterous on the face of it. I actually don't disagree with what she's saying in terms of like, if you're coming there and saying, hey, this is all foreign buyers that are doing this, that is definitely not the case.
That's not true.
But the affordability side, that's, I think, investor affordability when they're looking at purchasing here. They're like, hey, this is undervalued. I can see where this is going on the world stage. Yeah. Rates are low here. I've got money coming in. Like,
if you're bringing money in and your money's going further, and that you're not a Canadian trying to buy in Canadian dollars competing where your affordability ratios are totally out of whack, then there's a low affordability. Yeah. But for Canadians, that's not really true at all.
Yeah, and if the fact is true that 2/3 of Montreal are renters, I mean, there's your affordability right there. Yeah. But the major percentage of your population in your city, ideally you would want to be owning. Right. But anyways.
But the reality is Montreal is a high renter city, same as Toronto. It's just the way it is. You have a lot of jobs, you have a lot of good industries, you have a lot of young people who aren't either able to or ready to buy yet. So there is a higher renters demographic.
Exactly. It is going to be what it is.
Yeah,
though, right?
Yeah, exactly.
So anyways, we'll watch and see if that kicks in.
Yeah, interesting.
And then on the note of affordability, we've got this nice graph here. So when Trev is tracking these numbers, what they're looking at is the amount that you pay for an average price, an average home in Toronto on the Toronto Receipt Board. So those stats that we bring up every month. Yeah. It's looking at that with 20% down, and then how much of the average income from StatsCan that they get is going towards your mortgage and then your heat costs and property taxes.
Right. Okay.
So that's what percentage of the household income is it going to take to cover that. And for a while there, you can see it was so low. First, we'll address the beginning of the graph because it's pretty high. Back in the late 80s, early 90s, we had like 18, 20% interest rates. It was ridiculous.
Yeah, and that was due to the market conditions at that time, which we are scarily close to right now.
Yeah, barely touching. Yeah. Not even touching, really. But you can see our line there creeping up to that percentage of income that we're using. We're over 40% now for 2018. Yeah. And CMHC, when they look at your debt ratios for giving you approval for their insurance, and when banks look at it for when they're giving you your loans, that gross number that Trev is looking at there, it really should be 35%.
So the 40...
It should be 35. We're over already for that, and your total, what they would allow, is 42%. So that includes all your other debt responsibilities. So like car payments, exactly, any outstanding loans, stuff like that. That's capped at 42. We're above that. We're getting really close to 45% of your total income.
That's a big number to be floating at for just affordability. I mean, that's when you're looking at almost half of your income just to have a house and cover your basic costs. Yeah, your heat costs. Your heat costs and your property taxes. I mean, that's worrying. Yeah. That really is, Yeah,
I agree. Yeah. So we're going to move away from that. I mean, we don't really need to focus on it too much, but that is something that people have to look at and take into account. And that's also why we are seeing people getting approved for less money. Yeah. Because the bank's saying, hey, we're not, if it's going to take you 45%, we're not okay with that. Yeah. These are our numbers. These are what we think you can live in, and that's where we feel comfortable lending. So people are getting, qualifying for less money.
And they're not getting into financial trouble because they're stretching themselves just to buy. Just to buy, exactly. So, I mean, at the end of the day...
that's where the slowdown has come from.
It is. I think so, too. And at the end of the day, it's hard because for sellers out there who are trying to adjust to this different market and maybe wishing they sold 2 years ago or a year ago, whatever. The reality is
we missed the boat, babe.
I know. But this needed to happen. Yeah. And that's really what this is telling us. Like, we were just really getting into a danger zone, and we're still in a danger zone. And all of this stuff is being done for positive reasons, even though it doesn't always feel like that when the market's a little shifty, right?
Yeah. And actually, like, if we go back to Montreal just real quick before we wrap up our show, if you look at where they're at now, if they're going to hit that point as well, that point will come with or without the foreign investor tax. I think the foreign investor tax, like anytime the government makes a big policy change like that, it's going to put some doubt in people and it'll slow down no matter what. Yeah. But either way, if they keep creeping up, it's got to happen, right? Just like it happened here and in Vancouver.
Well, that's the thing. I mean,
the most expensive markets. Like
Yeah.
there is a ceiling on what that can be.
yeah, and it has to be controlled, and we are regulated as a country, and that's not a bad thing.
Not a bad thing at all.
For the most part. I mean,
Yeah.
there's always arguments on either side of that, but we won't get into it. But it's true, we are more protected, and we did avoid some of the negatives from 2008 and that whole recession and craziness that a lot of the world felt really heavily because of our regulations. So, there's always going to be pros and cons to that conversation.
Yeah. Our real estate market didn't get that here.
No, not really at all. A little bump maybe, but
barely.
that was about it. I don't even know if we really felt
You could have
that
called it a
hard.
seasonal hit.
Yeah, you could have. But I mean, I don't know. Anyway, that's really all I got to say about that.
Yeah. Well, so that's our show for today. We really hope that you enjoyed it. We come at you every Tuesday and Thursday morning.
Yeah, and as always, the links to all the articles that we referenced today will be down in the description, so you can check that information out, get a bit more info if you want. Other than that, if you have any thoughts, any feedback, any comments, please share, don't forget to subscribe so you don't miss the next episodes. Thanks so much for joining us.